Welcome to another episode of the MarkeTimers Team Talk. Today's guest is, once again, Angelo Gallo, a portfolio manager with extensive experience in retirement savings, who previously worked in the banking sector. Angelo focuses on macroeconomics analysis and uses current data as well as so-called nowcasting to guide his investment decisions. He has been trading on the stock market for over 2 decades, giving him first-hand experience of various market cycles. Angelo is here with us to comment on the current situation in the stock market, where opinions differ regarding the possibility of a bubble. Some believe we are not yet in a bubble, while others worry about a potential pop of the bubble. We will also address the recent DeepSeek model, the market's reaction to it, and what it might mean for investors. So, Angelo, my question is, we have heard about a new report on the DeepSeek model, and we can see how the market might be showing signs of overheating. Last year, SPX returned one of the best annual performances of 24% after the lengthy consolidation of 22 and 23. Are we just starting to inflate the bubble, and should we expect another consecutive great year? Or are we already in the midst of a mania and topping pattern has emerged? Or are we yet to witness a blow-off melt-up? In your view, what does the current market sentiment indicate about the state of the main equity index? And what implications does that have for investment decisions at this point? How does it compare to the 2021 mania?
There's a lot there, David, but I'll try and simplify it as much as I can. First off, let me say that I don't make forecasts as to where I think the S&P 500 is going to go. What I do, however, is I monitor growth, inflation, and the behavior of the Fed, the ECB, the Bank of Japan, the Bank of Canada, the Bank of England, so on and so forth, to understand what's really going on with the U.S. economy and the global economy. And let's just talk about the U.S. for a moment. So while a lot of people like to talk about how bubbly the U.S. stock market is, that may be true in certain sectors of the U.S. economy. But growth here in the U.S. is still well above 2%, probably more like 2.5 to 3. I don't see anything that suggests that growth is going to decelerate, let alone decelerate down to 1% or even down to levels that might be considered recessionary. David, are you still here? There we go.
I'm still here.
Okay. Thought we lost you. So growth here in the U.S. Is fine at the moment. People can, pick and choose maybe the labor market or hold to maturity accounts of the various American banks, so on and so forth. But fundamentally, at its core, the U.S. economy is doing okay. And what we are seeing over the past month to 2 months is actually, I'll call it a broadening out. And what I mean by that is that we are seeing a shift into financials, consumer discretionary, certain utilities, transports. And when you get that kind of rotation, right, those are simply different components of the S&P 500. And capital looks like a little bit is leaving from, I'll call them the Mag 7 because everyone's familiar with those names. And they're moving into these other sectors. And in fact, financials currently is and has been the best performing sector for the last couple of months. And consumer discretionary is a very close number 2. Now, consumer discretionary meaning what? Um, Apparel, restaurants, those kinds of categories, and those kinds of names. They're doing just fine. And so when you get a rotation inside of the S&P 500, that rotation tends to keep the S&P 500 propped up. So everyone, thinks that it's overpriced, it's bubbly, it's just a normal rotation, and the way the S&P 500 is constructed, it stays propped up. But I will point out that, the Russell 2000 is still below its November of 2021 all-time highs. And the all-time high in the Russell was 2,442. Today we're trading at 2321. So we have a long way to go. Now, a lot of people think that the dollar should decline. I actually, since late September, have thought the opposite. And the reason for that is because my work started to show that inflation was going to rise. So what's the impact there? Kind of suppresses earnings of smaller cap companies, number one. Bond yields have risen substantially over the past 4 months, despite what Jay Powell said on Wednesday. And my work says inflation's going to continue to go higher. And as that happens, for me, I started getting long agriculture, such as corn, wheat, soybeans, coffee, cocoa, beef, pork, that sort of broad basket. Why? Because inflation is going to, in my opinion, move closer to 3.5% somewhere around mid-year, not 2%. And in fact, on Wednesday, Jay Powell was asked, are you going to change your 2% target? And he said, no, absolutely not. So we're moving in the opposite direction. And I don't see any reason why inflation is going to turn around. I see nothing on my radar, at least for the next 5 or 6 months. And then we'll have to reevaluate.
I would like to hold on to your thought that inflation, you're expecting the inflation to be sticky or even to grow to get maybe another wave.
Yes.
But you also believe in strength in dollar. But if we rewind before 2022, right?
Mm-hmm.
Normally we would, before that year, we would talk about inflation equals weak dollar, weakening dollar. So what has changed? Why inflation now means strengthening dollar? What has changed?
It's very simple, David. Prior to 2020, prior to the pandemic, there was no inflation. In fact, the central banks did a ton of quantitative easing in order to keep us from slipping into deflation. Now we're in a new paradigm, and everything has changed. So COVID, they dropped $5 trillion of helicopter money onto the U.S. economy. And then they've been deficit spending by the tune of $2 trillion a year, 2020, 22, 23, 24. So that's another 2, 4, 6, 8 on top of 5, right? 11, 12, and it's still going. So when you continue to pump dollars into the system, it creates inflation. And that has been the paradigm shift that has now changed things. Now, I will say, when Trump talks about not putting on tariffs, the dollar tends to go down a little bit. On days when Trump talks about putting tariffs on, let's say, Canada and Mexico, like he did yesterday, the dollar goes up. So we have to see. Now, from a purely data-driven point of view, the U.S. economy looks fine. I'm long agriculture. I own some energy. I own small caps. I own some Israel. and some other consumer discretionary names, some restaurants and some individual names in the financial space. Now, having said that, I am very, very, very concerned about what Scott Bessent, he's the new Treasury Secretary, I'm very concerned about what his first move, second move, third move, fourth move is going to be in the coming days. And the reason I say that is because the previous administration spent a lot of money. As I'm sure your listeners are familiar with, Janet Yellen manipulated Treasury issuance, and she issued a lot of Treasury bills instead of 10s and 30s. And where did all of that liquidity that was created from all of those Treasury bills, where did all that liquidity go? It went into risk assets. So you can make a case that stocks are overpriced, and one of the contributing factors has been Janet Yellen's manipulation of the issuance of the Treasury curve. Scott Bessent can't continue doing that. The U.S. can't continue to operate like that. And I'm going to give you a couple of examples as to why. The first week of January, we had 2-year notes, 5 years, and 10-year notes come up for maturity, for renewal. We had new issuance. All of those tenors, if you go back 2 years, you go back 5 years, and you go back 10 years to the original issuance date of those different notes and bonds, interest rates were roughly 2% higher. Interestingly, the 30-year bond, which got re-upped again this year, 30 years ago, the 30-year bond was at 7.5%. So any new 30-year bonds that just got issued, were issued at 4.7, 4.8%, roughly 2 percentage points below 30 years ago. But that's not the case with the 2s, the 5s, and the 10s. Those interest rates are 2% higher. So when Janet Yellen skewed, all those interest rates are now substantially higher, and she was issuing fewer and fewer of the 30s. Scott Bessent has to figure out how he's going to normalize all of this, number one, in a manner that doesn't affect inflation, in other words, doesn't make it worse. He has to figure out how he's going to do it so that interest expense on the U.S. debt doesn't get worse. And he's going to have to figure out how the heck is he going to do it without having a ton of liquidity get sucked out of risk assets, without aggravating financial markets in some way. I don't think he's going to be able to do it. I think he's going to have a really hard time threading the needle and figuring out how to fix the trajectory of this ship. He's got his work cut out for him. So I'm very, very in the back of my mind, I'm really, really concerned about what he does, what he's going to be forced to do, and whether or not that results in a lot of liquidity coming out of risk assets, the stock market. And on
Do you
top of
believe
that,
so? This is in your opinion, currently the main macroeconomical risk, rather than Trump plays like tariff here, tariff there.
yeah,
You
I don't
think
care
that
about
is the underlying risk?
That's, Trump with his tariffs and Greenland and Panama Canal, that's all a sideshow. To me, the biggest factor is what I just described about how Scott Bessent starts to fund the U.S. government from today going forward. And if they have a hard time reducing the deficit, one way or another, either the bond market or the U.S. budget is going to have a problem. And so if Trump and his economic team thinks that they're going to be able to tiptoe through this, step through the raindrops and finesse fixing everything, I don't see it. Because
there is
some of the problems that Trump has inherited now are too big. We finally have gotten to the point where all of this stuff now matters.
And there has been a lot of talk that the new secretary might be quite radical. That we might get some reform in the magnitude of some major devaluations or something like that.
Well, Scott Bessent is a very, very experienced market practitioner. I've done a lot of work studying his past. And he understands the benefit of a strong currency. He understands how central banks devalue the purchasing power of the people. And he's not a fan of that kind of behavior. Not one bit. So it's going to be interesting to see how he interacts with Jay Powell. I don't know if he's going to tell Jay Powell, hey, this is what I want you to do. Cut the crap. Don't you dare cut interest rates. Now, Donald Trump thinks that lower interest rates are going to help fund the government. Well, all I can tell you is inflation bottomed back in September. It's been rising ever since. And the Fed cut rates by 50 basis points in September. They cut rates by a quarter in November. And they cut rates again in December. And what did bond yields do? They went up. The same thing's happening in Japan. The Bank of Japan raised interest rates 25 basis points last week. That wasn't enough. They're behind the curve in a really, really big way. If you put up a TradingView chart of the Japanese 2-year or the Japanese 10-year, those yields are now back to levels from 2007, 2008. So even though the Bank of Japan raised rates last week, interest rates in Japan are going up, not down. See, human behavior, everyone's been conditioned, central banks cut rates, rates go down. Not anymore. All of that has changed because they're so far behind the curve. The Bank of Japan should have raised rates minimum 50 basis points. Why do I say that? Because 3 hours before the Bank of Japan released their interest rate decision, headline inflation in Japan was released. And it was 70 basis points higher. It went from 2.9 to 3.6. So when the Bank of Japan announced, we're raising by a quarter of a point, you know what happened? Real yields in Japan actually went more negative, not less negative. That's no bueno. No good. And so now JGBs have been going higher. Why is Japan important? I've said this before, but I'm going to remind everyone again. The Japanese yen is a very, very important currency. Why? Because Japan exports capital all around the world. And when Japan gets nervous, they start to bring that capital home. And when they bring that capital home, it has a big effect on global markets, bond markets, stock markets, you name it. So Japan is really, really important. So this is why I pay such close attention to what goes on in Japan. I pay attention to their politics, and I pay attention to their economy, and I pay attention to what the BOJ does. Because it's really, really important to our market and even the European markets as well. So again, everything here in the U.S. is on the right track, except for those existential risks that I have no way to quantify. And we're not going to know what steps Scott Bessent actually takes at Treasury until he announces it or actually does it. And then, we'll have to, deal with what the consequences are. If liquidity gets sucked out of the market, well, I'm going to sell everything. It's that simple. I'm going to have a really quick trigger finger. And in fact, I do have a quick trigger finger. So while as far as stocks go, U.S. equities and global equities, I have a decent sized position. I'm not as big as I could be, simply because of these existential risks regarding Scott Bessent and what he does next.
There is probably one thing is debt refinancing risk, as you described. Second, we have this concentration of market. We have seen this on the DeepSeek news. Overnight, Nasdaq minus 5%, and this risk of concentration creates volatility. Normally, historically, in these prolonged bull runs, you would have VIX 11, 9 to 15 range. That would be something normal, because when price goes up, volatility should be low. Suddenly, we are on all-time highs. We are now trying to beat the high of last year, which was a record year of 24%. And VIX is, around 20, going all the way to 25. How do you think a regime change that institutions are now doing their risk management and vol control differently? They are now okay to hold, all in S&P with VIX 20, or is this heightened volatility on all-time highs, is that signaling something, some problems are ahead of us?
No. Vol control funds, CTAs, the algos, they do volatility scaling. And at the moment, nothing's going to change how they operate. And in fact, short-dated vol has been coming down. And the VIX itself represents 30-day and beyond volatility and put buying. It does not reflect the 1 day, 2 day, 1 week changes on the part of those mechanical players. But back to your question about DeepSeek, that's a very interesting thing, because the way I understand it, DeepSeek uses 8 decimal points, not 32, like American AI. When you ask it a question, it doesn't light up its entire database. It only lights up those parts of the database that are needed to address the question. The difference there now is that everyone realized, oh, maybe we don't need all of these full-blown AI monstrosity databases. Maybe there's a place for those, for those companies and whatnot that need that sort of thing. But for most people, for average people, and for most companies, the concept behind DeepSeek makes a lot of sense, because now it's way cheaper, it's way easier to use, it's fast enough, and it can run on a game board. You don't need monster, NVIDIA chips, GPUs. So I think there's been an awakening that, you know what? We don't need these full-blown monstrosities. They may be needed for certain applications, but not for every little thing. And that's that's the benefit of DeepSeek. Now, DeepSeek has its own issues because it's Chinese and privacy issues and so on and so forth, but it's not proprietary. So I think what we're going to start to see is that it's cheaper, it's fast enough, it's accurate enough, and so that's going to be good for everybody and for corporations in general. Their costs are going to come down because now not everybody is going to have to spend money on these expensive NVIDIA chips. So but that's what capitalism does, David. That's what technology does. Everybody thinks, oh, this is the new great thing. Well, guess what? Human
Do you
ingenuity
think
takes
this
and
development
something
could
brand
turn
new
around
takes
the
place.
And do you think this development could turn around the inflation? Because normally, historically, if we have inflation higher than 6%, that normally you will get another wave which will be even higher. But these technologies like AI, now DeepSeek, are are they so powerful that they could maybe make that this time is different? Maybe inflation will not have a big wave.
You know what, David? Anything is possible, okay? But my portfolio is structured on a 1 to 6 month basis, okay? And it's data driven. So if my work starts to see some change in growth, some change in inflation, some change in central bank policy, then that's when I start to make adjustments to my portfolio. I'm certainly not going to sit here and say, well, I think this and I think that, and put on a position based on what my brain thinks. That's just storytelling. And I don't operate that way. You know, I'm data driven. So do I like to think about these things? Sure. But again, to me, the most important thing facing us right now is Scott Bessent and how he handles the funding of the U.S. government. And what steps does he take to rectify the manipulation from Janet Yellen?
But market timers, we are also data driven, or we are more like statistically driven. We watch trend. We first watch what the markets are showing us, and then we extrapolate what does it mean, what the markets are pricing about economy. And sometimes markets are wrong. For example, bond markets in the beginning of last year, uh, the long-term yields were going down and prices of bonds were going up. But within our framework of trend following, we saw that this was just a bear market rally, nothing else,
Yeah.
which ended where it should have ended. And the stories around it were really crazy, you know. So the trend of bonds is downwards, and this is signaling more inflation, of course. What I don't understand is that the dollar is going up. Actually, if you look from higher time frame, like from quarterly or monthly, dollar is still consolidating. It went high in 2022, and it's still in some sort of consolidation zone. So I think market will still show us if this was just a temporary anomaly, that dollar is going up on inflation, or is that a new global regime? Um, and that is yet to be seen. But
Well, David, you know, let me say something about the dollar's been going up for 4 months. Okay. When I started to recognize that inflation was bottoming back in September, and it bottomed at 2.44 here in the US. October, it went to 2.6. November, it went to 2.7. And now December, it went to 2.9. Okay. And I'm looking for January to be a little bit over 3. Now, January doesn't get reported until I think February 11th. But late September, when I started to sense that, I started getting long the dollar. And every time it got to the top of the range, I sold a little bit, got down to the bottom of the range, added it back. You know my process. So you might say, well, why is the dollar getting stronger? Because inflation is rising here in the U.S.
I mean, I'm not
And
saying
the rest of the
dollar is getting
world,
stronger. I'm saying that dollar is still oscillating within a long-term range. We are still
well,
not above the highs from 20, if I'm not mistaken. We are still not above the highs from 20.
yeah, I think it was 114.
Yeah, and we are still not there. So yeah, we had 3 months of strength in dollar, but this strength has to still prove into some bigger move to the upside, some bigger count. And I think when the new secretary steps in with the new policy, that will be the moment when dollar just continues the uptrend which we are seeing now, or it will mean revert back into the consolidation. I think it will probably depend on that policy.
Yeah, well, let me add this too. That is true. His policies, or the Trump team policies, are going to have an effect. But you also have to remember, look, the rest of the world is actually slowing a little bit, whereas the U.S. is firm, right? And maybe even accelerating a little bit. When I say accelerating, if growth goes up 10, 15 basis points, that's an acceleration. So when the U.S. is doing that, capital's coming here, and that pushes the dollar higher. So, can the dollar get above 10 and start moving towards 114? Yeah, I suppose so. So as long as inflation's rising here, and the Fed turns around and like they did on Wednesday and said, okay, we're not doing any rate cuts, the dollar strengthened on that. Not a lot. It moved higher, 20 to 2 or 3 tenths of a penny. But that's just the way the dollar moves. So as long as this dynamic continues, I don't see the trend in the dollar reversing to the downside. Now, I'll also remind everyone that a stronger dollar is not good for the rest of the world. It's not good because most commodities are priced in dollars, and it's not good for those countries and companies that have debt denominated in dollars. Because now, if the global economy is on the sluggish side, that means they're not taking in enough dollars to pay their bills. So the higher the dollar goes, the more pressure it puts on China, the more pressure it puts on Brazil, the more pressure it puts on Vietnam and Thailand and everywhere else. So that's something else
what I was pointing to when the new secretary takes the job, and he will have a problem with too strong dollar. He might do some reform on the scale of Bretton Woods, and maybe do something about it and turn around the trend in dollar.
David, no, because a strong dollar is good for me. A strong dollar is good for the average American. Why?
So you mean Trump politics is a strong dollar?
I don't know.
To me, it's also not clear what is the politics.
Yeah, because here's what I do know. He's going to be very transactional. Okay? For instance, this is a good one. Everybody is trying to figure out, how is it that Jeff Bezos, Mark Zuckerberg, I forget the CEO of Google. He's one of the founders, I think. So people are wondering, why all of a sudden is Silicon Valley trying to get close to Trump? And the answer to that is very, very simple in my mind. In Europe, you guys have something called the European Digital Markets Act. Now, Europe basically doesn't have much in the way of technology. Europe is great at creating regulations. That's what Europe does. Okay? That's their economic engine, if you want to call it that, regulation. So the European Digital Markets Act has been a backdoor way for Europe to pick the pockets of American tech companies, right, without taxing them directly. Billions and billions and billions of dollars. And so Silicon Valley went to Donald Trump and said, hey, look, here's what's going on. Here's what Europe is doing to us. And you know what Donald Trump did a couple weeks ago? He said, if any European country levies any form of a tax on an American tech company, I'm going to put tariffs on that country. He was speaking directly to the European Digital Markets Act. And so that's how Trump is going to tell Europe, back off, cut the crap. And so that's the way he's going to play the game. Will he actually put a tariff on and have it stick? I don't know. That all remains to be seen. But what I do know is that Trump wants to get inflation down. He wants to try and cut some spending. He wants to get the U.S. economy to grow by reducing taxes, which I have, I have a pretty strong tax background, so I have a pretty good idea of what he should do versus what he wants to do. But we'll see. David, there's so many moving parts that there's no way to figure out what the end result is going to be, which is why I keep going back to Scott Bessent and the U.S. debt, the deficit, interest expense, and inflation. Because how they handle the Treasury issuance will, in fact, affect those other things. I kind of think Scott Bessent would welcome a failed Treasury auction. I think he would welcome that because then he can turn around and say, hey, you know what? We have to cut spending. Because, see, the market can't handle all of this debt that we have to issue. And on a final note on that subject, just last week, the primary dealer group, that's the group that handles Treasury issuance, they came out and said, our balance sheet capacity is getting strained. We don't have enough capital to continue to bring on more and more U.S. debt onto our balance sheet. And so that's all going to come to a head. I think sometime, fairly soon. Do I think Scott Bessent's going to do anything dramatic tomorrow? I don't. I think he'll try and take some baby steps. But in the meantime, the deficit is still blowing out, right? The debt is still growing. It's gone from 34, 35. It's now $36 trillion on its way to 40. And so that has to get funded. And if it doesn't get funded, does that put the U.S. into a recession? Maybe. I think if they cut the deficit even by $1 trillion, cut the $2 trillion deficit even down to $1 trillion, I think, that would cause the U.S. economy to slow down. Now, that would be a way to get interest rates lower, I think. And if they can get interest rates lower, now Scott Bessent can issue more debt at cheaper rates to try and finance the U.S. debt. But it's all very, very complicated.
So what you are saying, to summarize what you are saying right now, is that one way to deal with the refinancing problem of the government debt is to slow down economy by slowing down government expenditure, which would allow for lower interest rates, and that would help improve the situation.
That's my theory.
Well, this is Angelo Gallo. Thank you very much for joining this call, and hope to see you next time.
All right. Thanks, David.
If you have any questions, Angelo is regularly attending to the MarkeTimers Discord server. Okay.